Welcome back to the Dan Weston channel. And today we have a very special ETF review. So this will be part one, then I'll do SCHG, like a two-part series. I may, maybe I'll do a YouTube review of who talks about SCHG, what they say, like what I do with Tesla. Maybe. Could always do that later. So, um, I waited a little while. I'm well aware of how popular this is. I own it. I've owned it for a while. I waited long enough because I wanted to have a little bigger of a channel, more subs before I covered it because it's an important topic because a lot of interest in YouTube and Reddit is on this specific ETF. Okay, I've been a Schwab person for a long time. So I saw their ETFs, and then this came along some point in the years past. And then after got this, I found SCHG. So I got into that. So I'll explain more about why I like both together, probably in the SCHG video, because I don't have so much to say about that fund, honestly. But so here it is, Schwab's U.S. Dividend Equity ETF. Okay, so to note, it doesn't say growth, it doesn't say high. So there's no just a lot of dividend funds. The vast majority of dividend funds that exist are high dividend funds, which is an important disclaimer. There are some growth, which are the ones that I've been pushing. The ones that I'll review more are the growth dividend funds. Because for younger people, I see the demographics, most of you 20, 30-year-olds watching these, those are probably better options for you. And then you can always modify as you get older. So they just say they're a dividend fund, okay, which is kind of interesting. So it tracks the total return Dow U.S. Dividend Index. One thing to remember, so the benchmark index is the Dow Jones 100. Now, it's a little different from like DGRO. DGRO has a different benchmark, and they make selections from this group, like the total market. And there's no specific amount of stocks that can be in DGRO. It can fluctuate. So it's not always like 300 or 400. It changes, which you can go see that video. This one, it's like 100. So they select from the broad US market. So they take the broad US market, which Dow Jones, and then they score all the stocks, and then they create the top 100 scores become this index. And then Schwab just buys it. Pretty straightforward. So it's no humans make any decisions. This is a methodology based ETF. Like I said, I used to just say active or passive. So now I'm adding a third. Funds are active to me, human decision making passive. It's just blindly following some broad index, or methodology based where there's some sort of rules applied. It's like a benchmark, rules are applied. There is some component of humans, but not really per se decision making. So which is most of the ones I'm reviewing, honestly. So some stuff we can look at, turnover ratio, which varies because it depends every year. When they reconstitute this every year, turnover ratio could be 20%, it could be 40%. I have a feeling it's going to be a lot higher than this next year, and we'll go into why. So the turnover rate is going to be pretty high, I think, next March. So large value. So these are large companies that are going to be in this, nothing small. So here's your yield, the SEC yield, 3.6. That's why you're buying this, because it's almost 2% higher than SPY as far as their yield. Okay. So here's the current top holdings: Broadcom, Home Depot, AbbVie, Texas Instrument, Merck, Amgen, Chevron, Cisco, Pepsi, blah, blah. So great, long-standing, friggin' Mount Rushmore type dividend companies in America. So, okay. Now, mind you, every year these can change to some degree. So we can look at, so now here's the sectors, okay, and we'll look at the comparison. Okay, so we'll go to the next tab. Here's comparing this to SPY. You can see here the sector drift of SCHD versus SPY. So you can see you're much less in tech, which I don't think surprises anyone. You're much less exposed to tech, consumer services. You don't have any real estate. You don't have any real estate exposure, so that's obviously there. Utilities, yeah, not surprising. So what you are in with SCHD, you're heavy in staples and industrials, energy, finance. That's literally like half of, or over half of what you're in, is these three alone: industrials, energy, fintech, staples. Okay, so that's the biggest change. And they can show, here's the differences in the top holdings pretty much totally different. Like, I don't think any of the top holdings aspire in a SCHD. No, not really. Okay. So here's the hopefully I do this. Let me zoom in. Hopefully you can read that. Okay. So here's the prospectus. Like I always say, what are you buying? Let's read the prospectus. So management fee 0.06. Excellent. Very low cost. I like it. Okay. Goal is to invest in stocks that are included in the Dow Jones Dividend 100. Okay. Here's the part excluding. So remember, we've had this in other ETFs. Excludes real estate, which if you're going to hold this in a taxable brokerage, that's good. I would say that's because then you're reducing your taxes. Just DGRO does the same thing. So consideration. Okay. It excludes master limited partnerships because you don't need those in here, honestly. The it's complicated taxes. Preferred stocks, yeah, you wouldn't want preferred stocks. There are preferred stock ETFs separately from this, so I like that. That doesn't need to be in here to me. Convertibles, which would be like bond and debt issuances. Modified cap weight doesn't matter to you. Okay, oh my god, it's too much coffee. It's funny. All index eligible stocks must have sustained. Okay, so this is now the selection criteria of this is Dow Jones's selection criteria for the most part. No, I brought this up in DGRO. The selection criteria for the index for DGRO is different to some degree from what DGRO was. So the selection criteria of the index of the benchmark index of DGRO had dividend growth projecting forward in it to select them to put into the basket. And then DGRO had its own criteria to then pull from that basket to select the ones it picked. So it's kind of there is a significant difference between the two funds and how they operate. DGRO did have forward-looking dividend growth guidance. SCHD does not have any forward dividend growth projection or criteria at all. Okay. So here, 10 consecutive years of dividend payments. I didn't say growth. I just said 10 years of payments. Important. And I think they annualize. So as long as they paid something annualized, that would be sufficient. They have a minimum cap of 500 million. Okay, so we're not doing micro cap stuff. I'm surprised it's this low. I would have thought that this cap would be higher than this, considering this fund. I would have thought this would have been like 2 billion. That's kind of an interesting wrinkle with this fund. So they must meet minimum liquidity criteria. Okay, they go into that in the methodology page. Index components are then selected by evaluating the highest yield. So they take the four criteria and they equally score all four, and then that creates their entire list. And then they take like the top 100 based to make it short. So here's some of their criteria. So we got the 500 mil market cap, 10 years of payments. Then they look at fundamental based characteristics. So cash flow to total debt. This is my opinion. I would rather that they have done cash flow to long-term debt. So be it. They did total debt. Return on equity. Okay. Interesting. Dividend yield. Okay. Not growth. And then 5 years dividend growth rate. So they don't know. One important thing we can talk about, it's not dividend growth every year. They're looking at the cumulative 5 years for their growth rate calculation. Okay. So important. We'll get back to that with one specific entry they had this year. Stocks in the index are weighted based on modified market cap approach. No single stock can represent more than 4% of the index. Okay. And no single sector can be more than 25% of the index. Okay. So they do reconstitution. So remember, there's reconstitution and rebalance. Okay. Those are two separate things. They reconstitute in March. Okay. And then the Dow Jones 100 U.S. dividends does it every March. They rebalance quarterly. Okay. So quarterly rebalance is just to keep the weights from getting too crazy, basically. Something like Broadcom has run pretty substantially lately. So when they rebalance, they will draw that down most likely. And then this is kind of typical for a lot of funds I've seen. Schwab does this. So they say 90% of the fund's assets will be invested like I just described. And then they leave themselves like a 10% wiggle room for other things that they could do based on this paragraph. So let's see. if the investment advisors believe there's an appropriate investment with that 10%, that they could possibly invest in different ways than what I just told you. Um, so here, 10% net assets, not including the index. The principal types of these investments could include investments the advisors believe will help the fund track the index, such as investment securities not represented in the index. They could potentially pick stuff outside of the index during the year, is what they're saying here, just a small amount of the fund. Other investment companies and derivatives. So they could technically do a little bit of derivatives action in this. Okay. But it's going to be a small, unsubstantial amount. So let's see. What else do I have to tell you in here? So that's pretty much the most of what you need out of here. Then they go into the risks of that type of stuff. So here, the Dow Jones indices that we're basing this off of, you can go, it has a separate website from Schwab. Okay. So now we come to the methodology, which comes from Dow Jones, not from SCHD, this specific document. Okay. So we can see eligible securities are ranked by each of the four fundamental characteristics. Okay, free cash flow to total debt. Again, I'd like long term, but so be it. Annual net cash flow from operating activities divided by total debt. This is nice because this is indicating these need to be companies that generate cash flow by operating, right? So they're not generating cash flow through other means that are not just being in business. So this is, I like this. Good. Companies with zero total debt are ranked first. I mean, whatever. Good luck finding companies without, every company's got debt except for like tech companies, basically. But you're not getting tech companies because they don't pay dividends for the most part. Return on equity. So that's the second criteria. Annual net income. Okay, ROIE. Yield, 5-year dividend growth. Here's the formula. Again, it's not annual dividend growth. It's dividend growth for the 5-year period is the formula they use. Okay. The four rankings are equal weighted. Those four components get equal weighted to create a composite score of the broad U.S. market. Is what they start with, and then they take the top 100. Okay, are selected subject to buffering rule. Current conditions constitute. Okay, so they have to stay in that top 100. There is the potential, like it says here, the constituent stocks will remain in the index as long as they're among the top 200. So they could technically pull them out during the year if something like devastating happens. They could pull them out if they really get hammered, one of these stocks. Let's see. Yeah, non-constituent stocks are added to the index based on their rankings until the constituent count reaches 100. Okay, so that's that. You can read that. You go to the Dow Jones, the page, and download the methodology. It covers all the methodologies, so it's like a 50-page document. So this is on page 19. So we get a sense of that. Now here, one thing that I don't like the return on equity necessarily. I would rather they have picked maybe return on invested capital. I'm sure they have their reasons. Here's one thing I'll tell you about return on equity, which I don't particularly value. I don't, in my opinion. I'm not saying it's wrong, but I don't value this as a metric when I look at companies because it doesn't take into account leverage. So I could read this. A high ROE could mean a company's more successful in generating profits internally. However, it doesn't show the risk associated with that return. A company may rely heavily on debt to generate a higher net profit, boosting their ROE higher, and it will not reflect that. Okay. So drawbacks of ROE. Okay. Return on equity can also be skewed by share buybacks. When management repurchases shares, marketplaces reduce the number of outstanding shares, thus the ROE increases as the denominator shrinks. So ROE can be influenced by companies that use a lot of debt or use, and it'd be skewed by share buybacks. Okay. So I'm not a huge fan of that as a criteria selection. They have their reasons, I suppose. This is just my opinion. So here it is. And yeah, another weakness, ROE ratios may include intangible assets, yes, from shareholders' equity. Intangible assets are non-monetary items such as goodwill, trademarks, copyright, patent. So those are included. So if you want to, so you can look at the difference between return on equity, there's return on capital employed, there's return on invested capital. So there's you can go look at the difference. I like to use ROIC when I value companies. They do not. So that's my opinion. So we can look at, so this is how they do. Okay. So this is what time frame did I pick? Make sure. Okay. So I went a little further because it's funny because I don't want to be year to date because last year was the time to shine for this type of investment. Tech was down. you could argue these mature dividend producing companies had a great year last year, which they did. So it's an interesting to look at stocks in a 2-year window is an interesting because you had a year where dividend value companies did well, and then you have this year where growth made a major run back. So if we look in that 2-year period, you can do a comparison. So this was January last 2022 to present. So, take what you want out of this. SCH, or S&P 500, you're breaking even basically. But, Broadcom, which is currently there, fantastic returns. AbbVie did well last year, not this year. Texas Instrument, not so well this year. So Merck, that's kind of a weird one. Amgen, so that's a lot of reflection from last year's returns. So I don't know not so much value you can get out of something like this, just to give you an idea for performance. So taking a 2-year, this is like the next 5 in SCHD. You got Chevron, Cisco, Pepsi, Coke, Verizon, Pfizer. So 2-year look last year and this year compared to SPY. Performance wise, you got some pretty good winners. Like we're just looking like are there some winning investments in SCHD? So some not so much. This next batch, really the only one would be Chevron, honestly, that outperformed the S&P. So you got a few winners in this, not so much though. So here is this is just comparing it to some other dividend ETFs and the SPY again, 2-year period. I think we're doing 2-year, right? Yep, 2-year. So I mean, it's hanging in there. If you look at a 2-year window, no, not huge, honestly, not huge differences in performance. I threw in DLN because that's mine, which has done pretty well, actually, I should say, on a 2-year basis. I'm proud to say. It's literally just the top 300 dividend paying stocks in America. So that's just to give you a different idea. This is a high dividend Vanguard fund. This is a dividend appreciation fund from Vanguard. This is DGRO, which I've covered. Just to give you some performance. They're all total return. So here's the website for if you want to go look at more information, the Dow Jones Index, which is what this is benchmark. Here's the website. And then there's some documents you can download. Okay. Now we look at SCHD compared to the S&P 500. If I want a year to date this, obviously SCHD, not great. Okay, let's look at it in a 2-year window, which is, I think, gives you more of an idea of what you're buying. So let's go 2 years. Not really much different, honestly. Each one of these you could argue had its time to shine. So be it. All right, I've done this a few times. We'll back test. I always do 100,000. We go from 2010 to present because I'm going to reflect after a Great Recession, the whole quantitative, shenanigans by the Treasury. So we're comparing SCHD to VU, and then we are also comparing it to the Dow Jones because I think that's more of an applicable comparison than comparing it to QQQ. It's not really a fair comparison. So, I mean, pretty good. I mean, it did fall behind. It didn't perform as well as the S&P 500. I don't think anyone's surprised by that. It did outperform the Dow Jones. So take that for what you want. I'll zoom in. Okay. So now let's talk. We can look at the company's metrics. They rebalance the fund 25, 30%. So that's not the biggest thing. Here's some of the things I'll note about this fund. So we go to it. Let's go back to the SCHG or SCHD financials. So it's not even actually, it's funny because it's not that much different than SPY. I think SPY is like 11 or 12% financials, and this is 15. So it's not like a big difference. But the financial companies they do have in SCHD are regional banks, basically. They're not the big banks. That's an important disclaimer. They are different types of financial companies. And you had terrible exposure at the worst time. So, of all the things that can happen, this strategy, something very detrimental to SCHD happened this year. I don't know how many people actually understood because I see all the posts online. Well, why is SCHD performing so terribly? Well, this happened this year. There's a lot of regional banks. They're not a huge percentage, but there's a lot of regional banks in SCHD. the lower percentages at the bottom. So if you only look at the top 10 holdings, you won't see it, but they're in there. And they're all at the bottom now because a lot of them did very poorly because of what happened with the regional bank crisis at the beginning of this year, which was it March, April, May. So a lot of them did terribly. So this strategy failed you to some degree. The financial exposure was not, this was the worst time possible to have exposure to those types of banks in a raising interest rate environment. But obviously, SCHD doesn't have a metric to pull out regional banks when in an increasing interest rate environment where something could happen at regional banks. So this is what happens when you have a methodology based ETF. There's no humans in there. Like maybe a human would have seen a little bit to pull that exposure when things started getting bad, but you don't have that with this type of fund, and you're not paying a high expense ratio because of it. So that was something you could consider. I can even look if you want to, where the portfolio, we go to view all holdings. All right, I can go to the very bottom. Let's go. So, yep, Central Pacific Financial Corp. So there's one. Let's go to the bottom because most of them lost. This one, Hand Me Financial Corp. There's another little bank, Heritage Financial Corp, Premier Financial Corp. You notice they're all at the bottom. It's because they didn't do very well. They did not do well this year. This one might be a bank. I'm not sure. S&T Bank Corp. Yep. First Commonwealth Financial. So Northwest Bank shares. Now, there's nothing to say. You might think, okay, well, when they reconstitute, they will pull all these out because they did crap this year. I mean, but you're right. If they cut the dividend, they probably won't make it reconstitute next year. But there's nothing to stop SCHD from taking in new regional banks and putting them back into this fund. Okay. So for you to think they could lower their exposure to regional banks next year, maybe. Maybe they just replace the ones that failed with more regional banks that could have problems again. So just be aware of that. Here we go. More banks. C CVB Financial, International Bank Shares, Bank of Hawaii. That was oof. Stuff like that. Advanced Auto Parts was one of the worst performing stocks this year, I think, if I recall. Um, so it's important to look at because you look at the bottom because these were not at these weights probably earlier this year. These probably were much higher weighted when they reconstituted in March. They have now fallen. So, and they don't cap the fall. Like when they go over 4%, when they rebalance, they're going to rebalance. They don't rebalance the ones falling necessarily. Okay. So that's an important piece of this. Um, so dividend growth, I just was going to pull it up. So here's the dividends. You can see, I mean, so far, fantastic, right? This is why you're buying this. This is why you're buying this. You're not doing capital destruction like Tesla or a covered call ETF can there's huge risks to that. You're not having any of that exposure. You're just getting slow, steady, ideally growth of these really, mature, solid companies for the most part, hopefully. And over time, you're just getting slow capital appreciation and you're getting a really good growing dividend. This is what you bought. Um, if we go to the history, I mean, yeah, slow and steady growth. Where's the yield on cost? It's not here. Okay, dividend growth, yield. Here it is. So yield on cost, I mean, great. Yeah, you're doing well. If you bought this 5 years ago, you're getting almost a 5.5, and it's growing. The growth of the dividend. Where is the dang metric on that? Oh, here we go. 5 year. So 5 year, you got a 13% clip. 3 year, 9%, 10 year. So double digit dividend growth over long periods of time. Very good. So, and I did a I think if you did like a compounding calculator on these types of growth, even if you reduce the growth maybe down to like 8, 9, because it will probably slow down a bit. Um, the compounding snowball of this would be very beneficial, I think, to a lot of people as a part of your portfolio. I have it. Um, so good stuff. So here, now we're gonna get this is I think I had where did I put it? Okay. When it reconstituted, I don't think I have it pulled up. Give me 1 second. Okay. No, I do have the article. Let me pull it up. So this was when it reconstituted. So somebody did an article. So I just wanted to pull up the companies. So this was when it initially reconstituted in March. So you could compare this to what it looks like now. So you'll notice like Broadcom is far away, like the winner right now. Like we can go look. Broadcom done amazing. Broadcom's clearly holding this thing up this year, without a doubt. Broadcom is holding this whole fund up, and this goes to what we say. What is the stock market? You take a big diversified basket, and you're going to get a few winners, and they're going to be home run winners, and then those outsized returns will compensate you for a lot of them either going down or going sideways or barely going up. I mean, this is a perfect example. Like Broadcom carried this fund this year, leaps and bounds. Um, so here we are. So this is what it was in March. All right. So a lot of them are familiar. They've reorganized a bit. You know, the top 10 is not that different. Um, the one that killed me, the one that killed me was Ford. Ford killed me when I saw this reconstitution because this was before the banking crisis. So you couldn't say, "Oh, I saw that coming." Okay, I'm like, "What the hell are they doing, Ford?" I trade Ford, but like, why is Ford in SCHD? Because I can go look at Ford. Um, so I can go look. The dividend growth rate. So where is it? Growth. I mean, dividend growth, 5 years. It's like 5%. I mean, blah. I go to their dividend history. Okay, now go look. What do you see? Look at that. They basically cut their dividend during COVID. So Ford practically stopped paying a dividend. You notice they paid one, which is interesting. It's not that wasn't unintentional. So they cut to one dividend payment in 2020 and 2021. So I mean, management I think was where they needed to save money, lockdown, companies were in panic mode, lock the gates. They kept the one a year, I think, because they wanted to maintain their stats as being a consecutive dividend payer. They're aware of ETFs and investing at these companies. All right. They're aware of what ETFs hold these stocks. So they probably did this just to keep in dividend investments because if they cut it completely, all the dividend investing ETFs, this is my opinion, would have had to pull forward. So they were aware that they have to keep at least a token dividend to keep their streak going. And then they kicked back in. And then they had a special dividend recently, um, which I have my own ideas why they did that. But so you might be like, well, why is this in SCHD? They cut the dividend and it's within the last 5 years. I don't understand why this is in there. We can look. So if I go to the methodology, so yield's part of it. All right. But there's no, the yield reflects now, right? The yield this year. Okay. One other thing, 10 consecutive years of payments. So that's the screener. They did continue the dividend. They cut to one quarter per year those 2 years, but it's still consecutive years. They have the market cap requirement. And then this calculation, again, it's not every year growth. It's a 5-year calculation of growth of the dividend. I think that's kind of why they did the special dividend because I think that bumped them over is what I think. When they did this special dividend, that kind of locked in that they would, I think, meet the criteria of that. I'm not saying they did this because of SCHD. They probably had their own reasons for it, but this probably is what put them over the edge to get that dividend growth calculation to get them in SCHD. So I think this is kind of a flaw in the methodology for the selection of stocks in SCHD and Dow Jones picking them. Ford is a weird one to be in this. It just doesn't really it doesn't logically make sense to have Ford in this to me. That was a weird one. All the other ones kind of make sense. I don't love the banking exposure. I've never really been a big fan of banks in the first place. My opinion is still that they are underperforming assets for the most part. I don't really work. I've owned JP Morgan. That's about it because I wanted to buy the best in biz. I've looked at Goldman Sachs. I might own Goldman Sachs someday for my own personal reasons. So maybe I'm a lunatic. Um, so that's that. Okay. So what do I think? I'll pull myself up a little. Nope. Okay. So overall, 30 minutes. Not bad. I hold it. It's a sizable piece of my investing, my Roth. Okay. I understand what it's built for. You're not getting, you're not expecting to get stock appreciation like the market. That's not what this is made to do. Um, it's the dividend and it's the low beta is what's appealing. This has a lower beta than it's like 0.7, I think. So this will have less volatility um, than the market, hopefully. It's a solidly built fund. I don't want to be too negative. It's a solidly built, low cost fund. So I really like it. Do I think now let's apply what I talk about? Is it I'm gonna have a list from now on. So I'll probably like create a list and put on this video after I'm talking about it right now. I'll start because of all the ETFs I review, is it a core, is it a satellite, or could it be both? This is a satellite. This is probably maybe the controversial part. This is a satellite holding. This is not a core holding of your portfolio. And I know there's a lot of people out there that this is like a core position where this is could be 50 or 80 or 100% of your holdings total. Not, I'm talking about total holdings, not just your dividend portfolio, but if you have like a 401k and a Roth, this is not a core holding of your portfolio. It is not broadly diversified. So you don't have good exposure to a lot of, the majority of sectors. It's not diverse or it's not broad. It's only 100 stocks. I don't consider that a broad diversified ETF. The turnover ratio can be higher. I mean, I think someone said in the past, there's been years where it's had a turnover of almost 40%, which is due to it's only got 100 stocks. So it's a higher turnover ratio ETF. I don't like that. It doesn't have a lot of holdings. So this is a satellite holding. If you want to pair this, is how I do it. I'll talk about this more in SCHG. This is a good ETF to pair as a strategy with other growth centric investments, I think, because it will give you that stability you want in times like last year. So if you were a total growth investor, you got hammered last year and maybe you couldn't take it. You couldn't take the volatility. This takes some volatility out of your portfolio. So that way you're not under so much stress like last year when you're just getting your cheeks clapped, honestly, on your growth investments, and you might panic and sell because you've just had enough and you can't take it anymore. This could at least give you some stability that doesn't give you. And then you're set up for friggin' this year and off you rip. So it has a place in your portfolio. It shouldn't be your only, it's not your portfolio. It's a part of it. So this is a satellite holding. You could compare this to cows is an interesting comparison. Because did I compare it to cows? So we'll compare it quickly to cows. So cows is not that much different. I don't think cows is that different of a different. Obviously, they have different methodologies, but in the end, they're not particularly that different of investments when I looked at them. So if I look at cows, though, eliminates financials. So it does free cash flow, but it eliminates the financials completely, and it doesn't have REITs either. So if we look at cows versus SCHG metrics, okay, I learned this. You have to delete that one, then you do total return. Otherwise, it'll delete everything. So if you look like on a 3-year basis, yeah, cows is outperforming. 5 years, I'm not really that surprised, honestly. I think a lot of this is just straight up attributable to cows doesn't have financial institutions in it, and SCHD does. So you can go, I mean, cows doesn't have the same growth of its dividend, and it has a higher expense ratio. It does much higher expense ratio. I'm not going to argue that, but this is kind of an more interesting comparison, I think, because they're trying to accomplish similar things more than comparing SCHG or SCHD. If you're comparing it to something like a growth dividend investment or SPY, I think this is actually a better comparison because you can see the selectiveness of these mature companies. Cows takes out financials, SCHD doesn't. You could consider that. Cows is not a dividend investment though, but it does have those aspects. Just like SCHD is not a dividend. SCHD doesn't have forward-looking metrics, so it's not. You can't call it a dividend growth ETF because it doesn't have forward-looking metrics at all. So it's not necessarily a high dividend investment either because that's not its stated goal. It has dividend yield as a component, but it's not like the primary component. So like I said, that's the best I can tell you. There's good and bads to all investments. In certain scenarios, this will perform fantastic. In certain climates, it'll perform not great. But it's lower volatility. And if you want some stability, this could be a good way to go. Um, so I hold it. So if you think I'm being too negative, I do hold it. So I like this fund. Um, so that's that. So the one thing I'll say, you're doing it wrong. I didn't want to highlight anyone on Reddit. I saw so many Reddit posts. This is kind of why I started my channel, honestly. I'll be honest. Dividend and stock Reddit, I would see constantly. People would look at SPY and they would compare it to SCH, or hell, they would even do QQQ, but they were mostly comparing the S&P 500 to SCHD this year because they saw the great performance last year. And I think they might have thought that this was just going to continue forever. So they piled in SCHD last year when times are great. And I'm like, well, this is, it's a good year, but nothing lasts forever. It's a stable. It is what it is. I understand what it represents in your portfolio. And then those people would be like, this year as growth went crazy, they were putting, should I sell my SCHD and buy QQQ? I saw that post after post after post this year. And think about what you're doing. You are selling you're buying into green and you're selling when things go red. And that's how you underperform as a retail investor, right? When everything's happy, how many people, I'm sure people out there did it. You sold SCHD this year and you bought QQQ because it was going up. And tech was forever now for this year. What's going to happen next year is QQQ going to go down, and then you're going to sell now and go back to SCHD when it starts going up. So you're going to keep going the wrong way on these things. I don't think you really understand what does this fund do for you. So that's my idea on this. Thanks for listening. So it's been fun. This is one I knew was coming for a while. I'm a big fan of Schwab funds normally. I think Schwab's a great ETF provider. So I don't talk about Vanguard a lot because I'm a Schwab person and I like State Street. So I'll give you other things than Vanguard. Nothing against them, just my personal preference. But hey, hopefully I gave you some ideas, and maybe I might do a follow-up where I look at what other YouTubers have talked about CHD before, but I don't really want to go at I don't really know exactly what I'll find. I know there's so much content. I don't even know how I would figure out which ones to look at. Maybe I could find ones that are not providing good commentary on it when they talk about it. Like I can assess the information they're giving you and tell you if they did their due diligence to understand what this fund represents, or they just piled into it because it's popular and they're going to get views on it. But this is my opinion on it. So stay tuned for part 2. We will look at the growth fund of Schwab, which is not exactly the same, and it's not 100 stocks. So anyways, thanks for listening. My dog says hi. There he is. Wrong way. There he is. He's enjoying the sunshine. All right. We will see you later. Bye.